In problem E11-14, we are asked to determine the impact of a stock dividend and a stock split on stockholders' equity. In both cases, total stockholders' equity remains unchanged. Here's a quick review. In a stock dividend, you are distributing stock instead of cash to your stockholders. A stock dividend is expressed as a percent of the current shares outstanding. So a 100% dividend means that 100% of the current shares outstanding will be distributed. For example, if there are 10,000 shares outstanding, another 10,000 shares will be distributed. If it's a 20% dividend, then 20% of the current outstanding shares of 10,000 or 2,000 shares will be distributed. A large stock dividend is 25% or more of the current outstanding shares. A small dividend would be less than 25% of the current outstanding shares. With a large stock dividend, the par value of the stock will be taken out of or debited to retained earnings and then added to the common stock account. The money is simply moved from retained earnings to common stock, in other words, one stockholder's equity account to another. So the total stockholder's equity is unchanged. Our example is for a large stock dividend, but just so that you know, if it were a small stock dividend, we would be using the market value instead of the par value of the company stock to remove from retained earnings. And then we would transfer the par value to the common stock account and any extra to the additional paid-in capital. In our problem, Jones Corporation has the following capital structure. We've got common stock, par value of $1, 8 million authorized shares, 100,000 issued and outstanding shares. So there's no treasury stock. There's additional paid-in capital of $90,000, retained earnings of $170,000. They ask us in case 1 to show how a 100% stock dividend is how it affects the stockholders' equity section of the balance sheet. Okay, so before the stock transactions, they want us to fill this out here. Before the stock transactions, we have 100,000 shares issued and outstanding. So we'll put this here. We multiply that by the par value to get 100,000 as our par value. Additional paid-in capital of 90 goes there. It's already posted. The retained earnings, 170,000, is there. So the total stockholders' equity is 360,000. If we declare a 100% stock dividend, it's 100% times the current number of outstanding shares, 100,000. Well, 100% of 100,000 is 100,000. So we're going to give out another 100,000 shares to our stockholders. 100,000 plus 100,000 makes a total of 200,000 shares after the dividend. We had 100,000, we're giving another 100,000 away as a stock dividend, so now we have 200,000 shares outstanding. The par value stays at $1, so the common stock account is now 200,000. Where is that extra 100,000 coming from? Well, it's coming out of retained earnings. So retained earnings used to be 170. We're taking out 100,000, which is 100,000 shares at $1 a share. So we'll reduce it by 100,000, and it's down to 70,000. The additional paid-in capital remains unchanged. Okay, so the total stockholders' equity stays at $360. What we've done is we've taken $100,000 out of retained earnings and moved it up into common stock. And the way we got that $100,000 is we multiply 100% times 100,000 shares. That means 100,000 new shares at $1 a share. Remove it from retained earnings, add it to common stock. A stock split is different. With the stock split, the account balances don't change at all. What we do is we call in all the outstanding shares and we reissue new shares by whatever multiple is specified. In case 2, the board of directors voted for a 2-for-1 stock split, and the stock price prior to the split was $8 a share. So in our example, there are 100,000 shares outstanding. A 2-for-1 split means we multiply the 100 times 2, and now we have 200,000 shares. But we divide the par value by 2, and that becomes 50 cents per share. So the common stock account is unchanged, just as it was before the stock transactions, $100,000. So you take the split factor. Let's say it's a 4-for-1 stock split. We would multiply 4 times 100,000, and we would have 400,000 shares outstanding. And we would take the par value and divide by 4, and it would be 25 cents each. So the rule is take the split factor, multiply it by the number of shares outstanding, and then take the split factor and divide it into the par value. None of the stock accounts change, so additional paid-in capital remains at $90,000 just as it was before the stock transaction. The retained earnings remains the same, $170,000. In fact, we don't even bother doing a journal entry for our stock splits because none of the accounts change in their balances. We sometimes do a memorandum entry explaining what we did on that date, but we don't do an actual journal entry. If you have any questions, feel free to email me.